As stocks soar today, our next guest says the market is officially in what he calls the frustration phase of recovery. Tony Dwyer is the chief market strategist at Canaccord Genuity. He joins us on the fast line. Tony, always great to speak with you.
Hey, Mel, can't wait to see you.
I can't wait to see you in person, that's for sure. In terms of the markets, you think that we're in a range right now. Is that why you think it's going to be frustrating?
Yeah, so since this crisis began, as you know, we downgraded the market in January, and after that you went into a panic. And when you're in a kind of a crash environment, you go through three phases, and the viewers are probably sick of me talking about it, but the first one is the panic phase. Obviously, check mark, we went through that. The second one is the relief rally phase, and I think it's something that one of the guys mentioned earlier. As of last Thursday morning, the equal-weighted S&P 500 was within 1% of where it was 3 days after the rally began on March 26th. And it was exactly where it was on what we call the game-changing decision of the Fed on April 9th to buy high-yield debt. So I think what you get is last Thursday, people are talking about Wells Fargo needing some kind of help in cutting their dividend, and today the banks are up, the better part of 10%. So we're in this kind of, it feels like it's going to crash, and then it feels like it's going to spike, and in the meantime, it really doesn't do a whole heck of a lot.
Road to nowhere sounds like what you're saying for the markets. 2,800 to 2,950. We're right above that right now, Tony. So what are you telling investors to do? I mean, where do you hang out in this?
Well, I could see a little bit of follow through. Today was a good day. You can't, we put out a thing, as you know, this morning about the Fed. I never thought in my career, I've been doing this almost 35 years, I never thought that I would hear a Federal Reserve chairperson say, we're just printing money. We'll worry about what that means down the road, and there's no limit to the amount we're going to print. So whether again, get by whether that's right or wrong, good or bad, when they made that decision to buy the high-yield debt parts of the high-yield debt market on April 9th, that took the worst case off the table. That meant the Fed is going to make sure we don't go into or do their best anyway, to go into that 2008-style crisis. So what we're telling people to do at this point, following through, Mel, on the show that we did a couple of weeks ago, is if you're really overweight the quote-unquote COVID-19 trade, meaning the work-from-home stocks, and you're way underweight the banks and tanks, the financials and industrials, then normalize that. As you know, we're neutral weight the sectors until we get a better relative performance out of the banks and tanks, and until we see better signs in credit, like the U.S. Treasury market today, where you get a lift in yields.
Hey, Tony, it's BK. Good to have you on. I'm curious, what gets you uber bullish? Because prior to this and prior to your downgrading the market, you were one of the more bullish analysts, strategists on the street. So what changes your mind here from this kind of frustration phase to all clear, we're going to new highs?
I really think it's got to be signed. There's two things, okay, or three things, really. Number one is, if you look at what the Fed has said and done, it has led to a dramatic improvement in corporate credit, but it's still highly stressed. So if you look at where corporate spreads are, they're still stressed relative to where they were. So we put out a note last week that's probably, buy what the Fed is buying. They're the ones printing the money, and that's corporate bonds right now. But you need to see that really improve, kind of like today. You need to see the treasuries and other asset classes corroborate that it's not a work-from-home world. It's a going back to work in a normalized environment, and that comes with a vaccine. So that's a second thing. And you want to see like I said, the sector rotation really favor the economically sensitive trade versus the COVID-19 trade.
Hey, Tony, it's Tim. Oil's up 80% or so in the last 18 sessions, and we saw a lot of reflation out there today. Bloomberg article, there's other people saying China demand on oil has already come back to where it was pre-crisis. What are you doing with that trade? What are you doing with resources, which really should have a lot of room to run if there's even a little bit of hope here?
Absolutely. So that goes into the asset class. The second thing I mentioned is how you get super bullish, is you get kind of what follow-through you did today, Timmy. You get the copper prices, commodities. You want commodities higher, you want treasury yields higher, you want the yield curve steeper, and you want corporate credit rallying. We got all that today. But if you look again, I mentioned, if you go back and look at just at the end of last week, that was a relative performance low in the banks and industrials. So I want to see more than a spike. I want to see a trend. And, you know, this is good. You don't want to. This is an epic battle where the Fed is fighting the economy, right? The Fed on one side, the economy, and they're both an incredibly powerful force. I don't want to guess on a spike in either direction. I didn't want to sell them last Thursday, and I don't necessarily want to chase them, like you said, Timmy, up 7% from last Thursday today.
Tony, great to speak with you. Thank you, as always.
Thank you, Mel.
Tony Dwyer, Canaccord Genuity. Guy, last word.
Hi.
That's your last word?
Pardon me? No, it's not my last word. What I'll say is a couple things. You mentioned The Road to Nowhere, which has, ironically enough, a Talking Heads song. Just throw that out there, number one. Number two, I understand what Tony's saying. You know, if you think that things are going to normalize, there's nothing wrong with taking somebody off the table in a name like Zoom. But he also mentioned panic on the way down. And I got to tell you something. It's funny how people use the word panic when the market's selling off. But when it's up 900 points, it's like no big deal, nothing ever happened. Panic works both ways. It's just we associate things a bit differently when it's moving to the upside, Melms.